Okay, well, it gives me great pleasure to bring on board Manish Gunwani of Nippon Asset Management to talk about his new IPO, life in general, markets, what his learnings from the COVID are, and I'll also ask him a simple thing that how can one get rich and what is the best way to invest in this market? So Manish, what should we start with?
Your call, Nikunj. It's a long list you have.
A lot of time on the show. Okay. Why are markets not giving you clear signals? 3 months ago, the scare was inflation, inflation, inflation. Now, given the bond yield rally in the US market, the fear is growth, growth, growth. Markets need to make up their mind. Why that is not happening?
No, you're correct. This is probably the biggest dilemma in the market today, that equities and bonds globally are behaving very differently. So bond yields, as you correctly pointed out, in US have gone down 40, 50 pips. Whereas equities, even the cyclical stocks, while they've flattened and maybe corrected a bit, obviously they've not fallen too much. So that I think our base case, at least, is that this US bond yield fall is just a correction, because it had gone up from 0.5 to 1.6, 1.7 fairly quickly. I know maybe 30, 40 bips is too large to be just a minor correction. But really, the logic seems to be still that a lot of regions in the globe still are opening up. Vaccinations, if not working on cases, definitely in terms of death rates and hospitalization rates are working. So the base case has to be that the emerging markets like India and Brazil, which got affected by the second wave, will join the growth party. And, global growth should be strong. So I think we are going with the view that, also specific to India, Nikunj, I think that it's almost like, if not now, when? Because you have a fairly perfect macro combination almost, right? So you have strong global growth, you have low interest rates, both nominal and real in India. You have a consumption pent-up demand of 15 months, a capex pent-up demand of 7-8 years. You have a banking system which is cleaned out of most of the issues. So to me, growth seems a better bet than deflation at this point of time. Of course, you want to be nimble and monitor if US bond yields fall more. You really have to think about it. But I can't see anything to be pessimistic about growth. Your real-time data also on global growth is quite strong. Your PMIs or export data of Korea, etc., which is tracked a lot. If you see that, it is still quite strong. So I would still go with the view that both global growth and particularly India growth will revive.
Fair point. Manish, there are two pockets, one where there is stress and second where there is excitement, and both these adjustments have happened in and around the earnings season. IT stocks have gone gangbusters and pharma stocks have gone through the floor. Let's discuss the stress point again. Are markets right in assuming that pharma companies will have a drop in their earnings because that COVID uptick is not there? US FDA audits are coming back. Is the pessimism in pharma overdone or justified?
So overall, we are not very hot on pharma, in the sense that the stock obviously did very well in 2020. If you remember, in the immediate aftermath of the first COVID wave, most of the stocks broadly doubled or tripled or whatever, right? Now, the US generic pricing again has, the pressures have revived. On the domestic side, growth is okay, I think, adjusted for COVID. But if you see fire growth, even the domestic growth has not been great. And also, I think in pharma, what is happening is different segments are poaching on each other. So if you see, online pharmacy has bought diagnostics, a hospital chain today is seen as a digital play on pharmacy, diagnostics. So there is a lot of churn going around. So it's good, reasonable stocks, but nothing. I don't think there's a big cycle unless they correct a lot. And again, maybe there's too much pessimism about US generic prices. You can look at them as a big upside play, but at this point, we're kind of neutralish on the whole space.
When you see a success of Zomato, it makes you wonder that are we still dyed in old wool, because traditional investors always look at cash flow and dividend yield. When you stick to that old form of valuing, then are we missing on something exciting and new which is getting created? And the reason why I'm asking you this question is because I distinctly remember when FANG stocks went public, question marks were raised on Amazon, question marks were raised on Facebook, and question marks were raised on Netflix. But today the reality is that at least the first two names are $1 trillion market cap company.
Yeah, so I agree. I think this is not 2000 to my mind yet, at least. I mean, so if you go back to a lot of people compare it to that 2000 tech boom and bust. And there are some elements of that monetary policy is soft, real rates are low or negative, whatever. But at the same time, 2000 was about pets.com and webvan, which really didn't take off only, right? Now, clearly here, you are seeing business models which are changing consumer behavior, where there's a lot of adoption by the young consumers. So I agree with you. I think the whole narrative of, maybe this is because of lower interest rates, people have this luxury maybe of looking out far. But the whole narrative on growth stock can't necessarily be only cash flow and near-term growth. I think you have to look at unit economics. You have to look at what the earnings will be maybe 5-6 years down the line, and then size it up. You could still find the stock expensive, but you can't say that, oh, there are no earnings last 3 years. How can this stock be worth 1 lakh crore or whatever? I think that's not the right way to approach these stocks. I think it needs a lot of hard work, a lot of research, and you have to look out 5-6 years, see what can be the EBITDA, cash flow, whatever. And also the other part, Nikunj, what we've seen in a lot of these plays which are working in ecosystems which are exploding, it is not just the visible business that you need to probably value, because a lot of these companies, I'm sure, will go into adjacent categories. They will do some M&A. And if you go back, let's say you bought Google in the IPO early 2000s, you wouldn't know the amount of acquisitions they did, how they monetize search, they bought YouTube, etc. Right? So there is always be that premium about if the space is exploding, whether this management or company can create value by going into adjacent areas or buying out something cheap and then integrating it well. So there's a lot of questions there. I don't think I would consider it lazy investing to just brush these off.
Hi Manish, this is Mubina as well joining in. These last couple of months, we've seen a reversal of sorts. Pharma was doing well, it's now stagnating. PSUs, again, the July series has not been that great. Do you think IT could be next, which could now see the point coming in that, okay, we know that there's double-digit growth in FY22, the guidance has been strong. Do you think that all of the positives now are in the money and this is the best of the IT performance that we've seen?
Yeah, I think it will be difficult to argue for much re-rating from here. So I think what has happened with IT was, if you did, let's say, a 20-year growth rate of that industry, it was always dipping, right? So till about 2 years back, you took the long-term growth rate of the industry, it was a downward sloping chart. I think partially why it's got re-rated is that growth of the industry at least seems to have bottomed out. Maybe it's picked up a bit, whatever. But that that thesis that the industry in 10 years will become 2-3% below zero growth, I think now maybe there's more optimism around that. That's point number one. Point number two is maybe related to that. See, IT always had superb cash flows, right? So when you today look at consumer staples or some domestic pharma plays, the IT free cash flow yield was always much superior to them. So when this whole long-term growth kind of question, people have got more optimistic, then I think that re-rating was a bit natural. And thirdly, both from that whole digital usage perspective, so the demand outlook is better, and also from maybe there is some angle of geopolitics also here that with India becoming closer to US, some of the regulatory threats may get diluted in future about visas and stuff. So I think a lot of good things have happened with IT. You also had some bit of cost saving using work from home. And I think they'll still remain marginally positive still on IT because, as I said, on free cash flow, it looks good. If we believe that global economy and domestic economy is going to do well, then demand shouldn't be a problem. You also have a lot of stock buyback, so there is demand for the stock as well. So it's okay. Big return may not be possible, but still, I think among the growth at reasonable price sectors is still probably a shade better.
Manish, apart from financials, of course, you have materials, industrials. These are, among the next big weightage in your portfolio. They're very vulnerable to, not just the whole economy outlook bit, but also to costs. We are seeing inflationary pressure, no doubt, and for now it does not seem to be showing any signs of abating, at least for those costs that are specific to materials and industrials. Do you see profit pressure now going forward for the next few quarters?
Well, you mentioned two things. I'm worried about one, not so worried about the other. So what I'm not so worried is about cost and inflation that much. The reason is, especially in India, a lot of inflation is related to food, fuel, real estate. I honestly think these three big items should not have, on a 2-3 year basis, any big, compounded growth rate in pricing. Because one is, if you see fuel, which is about oil, I think 70, 75, if you see any global strategist work on oil or whatever, you will find that beyond 80 is something no one is predicting because there's technological threats around oil, right? You have electric vehicles, you have renewable energy, etc. Food, at least rice and wheat, I think India has sufficient production. FCI stocks are obviously very high. So it's more a matter of policy choice rather than a shortage of production. And I think also real estate prices, while we're positive on volumes going up and velocity of business, but if you see rental yields, etc., I doubt if real estate prices next 2-3 years will go up a lot. So in an environment where, maybe oil will remain flat for 3 years, rice, wheat are sufficient, there is productivity gain in agriculture, and if real estate prices are flat, I'm not so worried on cost part. I think we probably have peaked out on that concern. The first is about growth. Now that, while I think the top-down is near perfect for India, as we discussed earlier, the very fact that the bond yields have gone down is the only thing that is giving you cause for concern, because if the global growth drops a lot, then even India growth does get affected. I'm a bit more concerned on growth because ultimately, while all top-down elements are there, you just want to see it happen. So we've not seen momentum in bank credit, for example, or car sales as much. Now, obviously, there is a second wave effect, so it's too early to see. But I hope next 6 months, if a lot of these parameters don't show momentum, then you have to worry about growth, I think.
Manish, intrigued to know about your NFO, that's the Flexi Cap Fund. Tell us a little bit more about it. And more importantly, you know, one senses that there's a high exposure to small and mid-cap stocks in here. Why is that?
So we are very excited about this product because obviously this is a fund which gives you a lot of flexibility. You can move between large cap, mid cap, and small cap wherever you want. And we've seen there are 2-3 year phases where each of these segments leads the market. So if you can ride those phases, I think the potential to create return and alpha is obviously much more than some other categories. So it is a large category. By AUM, it's I think the second biggest. So this is obviously a fund we're very excited about. On the fund structure, you're correct that generally we feel that we will have a bit more of mid and small cap across the cycle versus a lot of other funds. I just think that it's just going to be a more vibrant space, especially given the kind of, let's say, 2 mega trends we're seeing. One is this whole technology disruption affecting a lot of sectors from auto, retailing, power, everything, right? So you will see new business models, you will see aggregators, fintech, e-commerce, gaming, a lot of stuff happening on the technology side in the mid and small cap space, I think. The second mega trend is this whole manufacturing shift, which again also is expanding into new segments after, let's say, chemicals, electronic manufacturing. You're seeing a lot of positive tailwinds for textiles, steel, etc. So you have a lot of churn, I think, happening in the corporate space, which will get reflected in the mid and small cap space. Also, if our thesis on growth coming back works out, generally mid and small caps have more operating and financial leverage. See, India has been, in a sense, growing below potential for almost 7-8 years now. And that phase has led to the large cap space becoming dominated by defensive business models, right? Whether it's staples or pharma, IT, etc. Now, if growth comes back, I think a lot of other sectors' earnings should impact more. As of now, it's a hypothesis based on a lot of top-down positiveness. But let's see. If that works out, I think the mid and small cap space will get another leg to outperform.
Is that the approach that retail investors, Manish, need to have right now? Because, you know, you can't chase, I mean, you've got to be market cap agnostic. It's individual stories, and if they are in the small and mid cap universe, traditionally as risky as they may be, so be it.
In terms of outperformance, mid and small cap may outperform going forward. For the retail investor, and in fact, for probably every investor, I think the holy grail is good asset allocation, and you just need to have the discipline. I think there is a lot of feeling that the market has gone up a lot since March 2020, but on a 3-4 year basis, it's not very extraordinary returns that have manifested in the market. So I think it's not a time to be maybe either underweight too much or overweight too much of the base asset allocation you should have. I think whatever strategic asset allocation you have in equities, you just have the discipline to maintain that. I think that's very important at this point of time.
Manish, good luck. Good luck with the NFO. Thank you for joining us, and we've covered a range of topics. What you called has been an interesting conversation. It lasted for 20 minutes, but pleasure to have you on ET Now.
Thanks for having me.